Hi, welcome to the Mountain Path Academy. This will be a series of lecture session on financial derivatives. So today we'll start introducing financial derivatives. So let us directly go into and so what are financial derivatives? So let us not go by the classical textbook definitions. Let's simply understand what are financial derivatives. They are financial contracts and whose value depends upon an underlying asset. It could and or index. So that means these financial contracts create a right or an obligation to buy or sell and or exchange value at a predetermined price at an agreed formula at a future date. So it's basically a financial contract that deals with the right or the obligation to buy or sell. So unlike a spot market trade, which is settled immediately within the standard period, a derivatives contract specifies the terms of settlement for payment at a future date. So the value and the payoff of derivatives are determined not now at a future date. The contract is decided today. So underlying references or assets in derivatives contracts can be grouped into three categories of asset classes. Financial assets can be stocks, bonds, currencies. You have physical, tangible assets like commodities, precious metals, agriculture products. And you have notional references or assets like stock market indices, interest rates, and inflation. So the underlying assets in a derivatives contract can be classified into three broad asset classification. And financial derivatives can be classified into two broad categories. One over-the-counter derivatives, that is OTC derivatives, where the contracts are directly dealt between the parties without the involvement of an exchange or a third party. An exchange-traded derivatives, where the contracts are routed through an exchange. So example of a OTC over-the-counter derivatives are forward contracts and swaps. And examples of exchange-traded derivatives are futures contracts and options. The purpose of financial derivatives is to manage financial risk or mitigate financial risk, either through and price guarantee or performance guarantee. So most of the derivatives have got a price guarantee or a price protection or a performance protection. And most commonly, derivatives are used to lock in the prices so that they protect against the future price movements or volatilities. So, example of a simple derivatives contract: Mr. X agrees to buy 50 tons of copper from Mr. Y at a price of $10,000 per ton in 3 months' time. A simple contract where you can identify it. Mr. X as the long party buyer, Mr. Y as the short party seller. And the copper is the underlying asset in the contract, and the contract quantity is 15 tons. An agreement contract price is 10,000. So financial, that is settlement period is 3 months. So we can always refer which is most important variable in the contract is the contract agreement price. We can going forward in all discussion we refer as a variable K. So that the whole derivatives contract deals with an agreement to buy and agreement to sell most of the times. Simple example of a derivatives contract. So this is also an example of a forward contract. So what is a why Mr. X takes a long position in the contract? We use the word long and agreement to buy. So Mr. X expect the price of copper might increase in the future, so he wants to have a contract so that he can buy the copper, 50 tons of copper at $10,000 per ton. So he wants to lock in the price. Mr. Wise expect the price may decrease in the future, so he takes a short position to lock in the price. And this is a simple example of a forward contract. And the main thing is the contract in a forward contract we'll discuss in the next session. The settlement happens at expiry. And so that means we decided the profit or loss from the contract for the long or the short party is decided by the price at expiry. We call it as spot price at T expiry. So very simple. When the spot price of copper is $6,500 per ton, and the contract buyer says, I will buy it 10,000. So that means he will have potential loss of 3,500. So we call it as a ST minus K. ST is the price at expiry, and then K is the contract price. For a short party, he is going to sell at 10,000 and the market price is 6,000. So he makes a profit of 6. So that means for different various settlement prices, there'll be one settlement prices. So we can see that and the long party's profit comes at the expense of the short party, vice versa. So we can also have a nice payoff for a long ST minus K and and a long party payoff and a short party payoff. So we can easily calculate that. And now, so the payoff formula is ST minus K, and for short part is K minus ST, and the break even is ST is equal to K when the neither party makes any money. So it is general derivatives or zero sum game. Most derivatives contract or zero sum game. That means the profit comes from the expense of the other party. So next session, and we'll go into little more details in a forward contract. But there are three broad categories to complete it. Three broad category users of derivatives. The first is the hedgers. So hedgers means the market participants and who have got existing or anticipated exposure. Let's say an exporter or an importer or a manufacturer who has got commodity prices. So it got exposure. Exposure means that they have risk. And arbitrageurs, traders who take profit from price differences across markets, two different places. So let's say if your trader finds a futures price of a particular derivatives at two different prices across two different markets, then he can sell it and high, buy it low. Speculators, traders without any underlying exposure who take market position to seek profit. So the three broad categories of users of derivatives. In real world, most of the traders are and speculators, 90%. But big institutions, they take actually, they have exposure. They use derivatives to mitigate financial risk. This is all about introduction to financial derivatives. And the next session we'll discuss about and what is a forward contract. What are the important forward contracts? So how do we deal with the settlement of a forward contract? And what are all the and downsides or issues or defects in the forward contract? How do you mitigate them? So thank you for watching. Thank you.